Hey, what is happening, options traders? Well, can you pay off your mortgage day trading Tesla? So I wanted to post this video in response to another post that a trader in our group put up there the other day about another trader who is out there advertising on YouTube this very claim: pay off your mortgage by day trading Tesla. And this isn't the first time we've seen ridiculous day trading claims like this. We saw Jason Bond a couple of years ago, who I talked about, and just recently got fined $137 million by the SEC for running a scam. No shockers there. But it turns out that there's always going to be people who believe this stuff. Everybody wants to believe that they can have this passive income stream by just day trading stocks. And so it becomes very difficult to show why it doesn't work. Except, is there a way? Is there a way we can mathematically show that this will never work? Well, the answer is yes, there is. So let's go find out. And before we get started, as always, please click like and subscribe. It goes a long way into promoting the channel and is always very much appreciated. So first off, day trading systems, what are they all about? Well, they claim to teach a set of rules where you can make consistent profits. And again, it sounds plausible. You might think, well, in other areas of life and other professions, if you know the little tips and tricks, you're going to do better than average. And that's what these people are teaching you. Well, again, that sounds possible. It's just simply not true. And part of the reason is that the only way for you to make profits is if another trader loses. See, in the day trading world, it's a zero-sum game. You've got yourself and somebody on the other side of the trade. That's not really true in the stock market, because if, let's say, Microsoft goes up $1, the vast majority of Microsoft holders make money. It's not like half made and half lost. And that's because they are owners of equity. But when you are day trading, that's not true. You've got a buyer and a seller, you've got a long and a short, and one will gain and one will lose. So another thing to think about: if it's so easy to make money with these systems, why are there any losers at all? And yet traders don't stop to think about this stuff. They just say, oh, everybody's teaching these day trading systems. There's tons of people out there teaching them. And so if they're all so easy and so simple, you'd have to think that everybody knows about it in this day and age with YouTube. If it's just that well known and widely publicized that they're out there posting it for free on YouTube, then everybody's got to know about it. But again, people tend to just think that this is true. Well, it's just simply not. But is there a way to show it mathematically? Yes, there is. And we've seen this formula before for other purposes. But let's just divide our market into two different camps. Let's say that out of all of the investors or traders out there, that there's two different camps. We have a passive group, and these are people that just want to get the returns of the market. And then we have the active group, which includes the day traders. And of course, the passive plus the active group must make up our entire market. So all investors, traders, day traders, whatever you want to call yourselves, must fall into these two camps. So the next thing to look at is, and it doesn't really matter which numbers we use, so I'm just going to start off with 30%. Let's just assume that 30% of our market falls into the passive camp. They're just going to buy the S&P 500. They're just trying to match the returns of the overall market. Well, if 30% of the market is passive, no surprises here, 70% must be active. So if this is true, what can we infer here? Well, let's say that the SPX, the S&P 500, returns 10%. As before, it doesn't matter what number you put in here. Just pick something. So this is the overall return of the market at the end of the year. Well, if that's true, we know that 30% of the market, our passive investors, must have also made 10%. Why? Because that's all they're trying to do. They're either buying the S&P 500, the SPX, SPY, mutual funds that track the S&P 500, or they might just be holding a well-diversified portfolio of stocks. They're going to get the return of the market. But now here's where it gets interesting. What does this tell us about the remaining 70%, our active traders? So for those of you with a little bit of math skills, how would you fill in that question mark? What's the only number that can make that entire equation true? Well, it turns out it's also 10%. And the reason for this is that, again, the passive plus the active makes up 100% of the market. So, as I said before, it doesn't matter which numbers we use. Let's switch them around. What if instead we assume that 70% of the market was passive? Well, therefore 30% would be active, and we get exactly the same answers. What if we wanted to assume that 90% were passive? Well, therefore 10% would be active, and we get exactly the same answers. Everybody has to earn the same return of the market, at least on average. This is where things start to differentiate. So, for example, if you're a passive investor, everybody gets the same 10%. So your bell curve, actually it wouldn't be a bell curve, it would just be a straight line. That would be your distribution. Everybody gets 10%. It's not like some people got 11 or 12 and other people got 9 and 8. They all are doing the same thing, and they all are getting exactly the return of the market. But it's a little different over here on the active side. Yes, on average, they are gaining the same return of the market, but they will have a bell curve, and half of the traders in here will win, and half of the traders will lose. In other words, half will show profits, half will show losses. But the average gain out of all of these active traders must be the return of the market. So what you're trying to do with day trading is saying you're trying to exceed the return of the markets by applying some rules, trying to look for patterns. But once again, you're looking for patterns that supposedly everybody else knows. And you can't beat the averages by doing what the average person is doing. Now again, you might say, well, hold on a second. How do we know that this is what the average person is doing? Well, again, go type it into Google. Look it up on YouTube for day trading systems. You will get hundreds and thousands of sites, and everybody's teaching the same stuff. Use some stops, here's support and resistance, here's some candlestick patterns, as if it is just free money. And the reason that they teach the simple stuff is that these aren't real professional traders. They are marketing companies or people just trying to make a quick buck by teaching you a system. So a couple of final thoughts. First of all, if it were this easy to make money by day trading, to where you could pay off your mortgage by day trading Tesla, everybody would be doing it. It would be the only job in the world would be to day trade stocks. And second, if it's this easy to make this kind of money, why are these people willing to sell it to you for a relatively small monthly subscription? That's a really good question. But the answer is they want you to hold the risk, and they want to get that nice, steady, passive income that you're trying to get. But people still fall for it. They want the easy money, and so there will always be people to sell it to you. And the reason is it's the oldest game in the book because it's the easiest to sell. The better way to approach the markets is to take the long-term view, but learn how to hedge, roll, and morph positions to stay in for the really big profits, but manage the risk. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.